This week we're going to cover the contribution margin. And the contribution margin, you need to be aware of revenues minus expenses. So remember that, revenues minus expenses. The other element that we need to focus on is that there's going to be a contribution margin per unit. So contribution margin being revenues minus the variable expenses, and the contribution margin for 1 unit of product or 1 unit of service is defined as the contribution margin per unit. And that's going to be now revenues per unit minus the variable expenses per unit, okay? So let's differentiate. Contribution margin is revenues minus variable expenses. Contribution margin per unit is going to be the revenues per unit minus the variable expenses per unit. So if we look at a company like Jiffy Lube, that they provide oil changes, and we want to know what the contribution margin per car is per oil change, that's going to be computed as follows. You have revenues per car minus variable expenses per car. So if the contribution, if we're going to find what the contribution margin per car is, you know, if let's say that the revenue is $24 and the variable expenses per car is $9, 24 minus 9, the contribution margin per car is $15. So the contribution margin per car is going to let you know that after the variable expenses are covered, each car serviced will provide or contribute $15 toward the oil, you know, to the oil change company's fixed expenses for Jiffy Lube, okay? So you figure that out so that you know that $15 is going to contribute to Jiffy Lube's, you know, fixed expenses. And those expenses can be $2,400, you know, per week for a company like them. So after the $2,400 of weekly fixed expenses have been covered for Jiffy Lube, then the company's profit is going to increase by those $15 per car serviced. Okay, and the contribution margin and the contribution margin per unit is important to know, because then we're going to focus on the break-even points in units. And the break-even points in units for Jiffy Lube is going to be the number of cars that it needs to service in order to cover the company's fixed and variable expenses. The break-even point formula is to divide the total number of fixed costs by the contribution margin per car. So that's why it was important to go over the contribution margin per unit, or per car in this case that we're working with Jiffy Lube. And then we're going to look at the break-even points in units. So looking at that same example, if we look at the break-even points in units for Jiffy Lube, the break-even point in units for Jiffy Lube is the number of cars it needs to service in order to cover the company's fixed and variable expenses. So the break-even point formula is to divide the total amount of fixed costs by the contribution margin per car. So if we look at the break-even point in cars per week, we're going to look at the fixed expenses per week, and we're going to divide that by the contribution margin per car. And if we get $2,400 per week divided by $15 per car, we get 160 cars per week. So it's always a good idea to check your calculations, and then you know, we can also look at I can itemize a list of items for you to, you know, so that you can you know, see how you know, these calculations play out in the break-even point for Jiffy Lube. So if we want to look at the projected net income for Jiffy Lube, you know, I prepared a small net income you know, statement here for you. And if we look at the sales, okay, remember that when we talk about sales, we use sales and revenues and fees earned. You know, we use those terms interchangeably, but they all mean basically revenue. So in this case, sales, because Jiffy Lube serviced 160 cars, and they serviced them at $24 per car, and $24, and you serviced 160 cars, that's $3,840. The variable expenses is that you have 160 cars at $9 per car, because remember that the $9 we got from the contribution margin per car, which was $24 minus the variable expense per car, that was $9. Okay, so we get $9 times the 160 cars that we service, that's $1,440. So we look at the sales, which was 3,840 minus the variable expenses, which were 1,440. Our contribution margin there is $2,400. Okay, and we had $2,400 in fixed expenses. You know, we broke even with the net income. Net income is zero. Okay, so you know, the contribution margin per unit, and the break-even analysis are crucial components of this week's objectives. Okay, so we need to fulfill the week 4 objectives through your readings, through the successful completion of your discussion questions, and through the successful completion of your assignments. So in week 4, you're going to successfully fulfill the following objectives, which are going to be for you to calculate the unit contribution margin and the contribution margin ratio. You're going to use the cost volume profit analysis to find break-even points and target profit volumes. And you're also going to use the cost volume profit analysis to measure the impact of changing business conditions. Now remember that the cost profit volume analysis is known also as the CVP. All right, so we're going to calculate the unit contribution margin and the contribution margin ratio. It's a powerful tool that helps managers make decisions. So whenever you see CVP, which is the cost volume profit analysis, it's a powerful tool that helps managers make important decisions. And as I have told you in previous weeks, you know, the objective of the course is that you can use this accounting information to make, you know, powerful managerial decisions. And the branch of accounting that we're mainly focused on is the managerial accounting, which is focusing on a lot of cost accounting concepts that ultimately go back into the financial statements, and they impact those 4 financial statements that we've, you know, talked about. So cost volume profit analysis is also important because it expresses relationships among costs, volume, and the company's profit. And it determined the sales volume needed to break even and earn a target profit. The components of a cost volume profit analysis includes the sales price. And you remember the sales when we were looking at the Jiffy Lube case example. And when we look at the sales price, we're looking at, for example, the price charged. Let's say that you know, the price we were charging for the oil changes. But we can look at a printing company and we can look at the sales price for the price charged for each poster. The volume is going to be the number of posters that we actually produce. So the price for each poster, the number of posters that we produce, the variable cost for the posters, which are the costs from the suppliers. And then we have the fixed costs, which are the monthly website maintenance and rent. And then we have a profit or loss, the company's operating income. So again, the sales price is going to be the price charged for each poster. The volume is going to be the number of posters sold. The variable costs are going to be the costs of the posters from the suppliers. The fixed costs are going to be the monthly website maintenance and rent. And the profit or loss is going to be the company's operating income. Cost volume profit analysis assumptions are that sales price remains constant throughout the relevant range of volume. Managers can classify each cost as either a variable or fixed. Inventory levels will not change. The product mix offered for sale remains constant. So we're going to look now at the contribution margin and the unit contribution margin, the actual definitions of them, and you can relate to the examples that you saw earlier in the video lecture. So the contribution margin is the excess of sales revenue over variable expenses. So that's why I told you sales minus variable expenses. And the unit contribution margin is the excess of the selling price per unit over the variable cost per unit. Again, that is the excess of the selling price per unit over the variable cost per unit. All variable costs, which could be product and period, they must be included when calculating the unit contribution margin. Some more unit contribution margin examples that we can give you. Let's look at the poster company, and the company is called Kay's Posters, and Kay has an online poster business. She currently sells each poster for $35. While each poster has a variable cost of $21, Kay has monthly fixed costs of $7,000. So her relevant range from 0 to 2,000, and she is currently selling 550 posters. Okay, so if we look at the contribution margin example for Kay's posters, her sales revenue, she's got 550 posters at $35 per poster. You multiply $550 times $35 per poster, you get $19,250. Less the variable expenses. Well, you know that you still have the same 550 posters at $21 per posters. 550 times 21, you have $11,550 of variable expenses. So your contribution margin is, you get the $9,250 minus the $11,550, and the difference is $7,700 is your contribution margin. Again, sales revenues 550 posters at $35 per poster, $19,250. Variable expenses 550 posters times $21 per posters, $11,550. You subtract, you get the contribution margin of $7,700. Less her fixed expenses, which were given in the case, are $7,000. Your operating income is $700. So Case Posters operating income is $700. The unit contribution margin example for Case Posters is that the sales price per unit is $35, and she has the variable cost per unit for each poster is $21. $35 minus 21 is $14. That's the unit contribution margin. That's similar to, what we saw for Jiffy Lube. They had $24 was the sales price minus the variable cost per unit was the $9, so their unit contribution margin was $15. In the posters case, it's 35 minus 21 is 14. So Kay earns $14 every time she sells a poster that can be used to pay fixed expenses and earn a profit, just like Jiffy Lube was able to use the $15 every time they, provided an oil change. Then we have the contribution margin ratio, and that's the ratio of contribution margin to sales revenue. So we get the unit contribution margin and we divide by the sales price per unit, and then we get the contribution margin and we divide by the sales revenue. So the calculations are going to be, we look at we focus on the units first, and we look at K's calculations, and that's going to be $14 divided by the $35 of each poster, and that's 40%. And then we get, if we look at the overall sales revenue minus and we look at the contribution margin, we see that it was $7,700 divided by the $19,250, and that is 40% as well. So the unit contribution margin and the contribution margin gives us 40%. One, you do the units, which is $14 divided by the 35, and the other one is the 7,700, which you divide by the 19,250, you get the 40%. Now, use the cost volume profit analysis to find break-even points and target profit volumes. So the break-even point is the sales level at which operating income is 0. Total revenues equals total expenses. Sales below break-even point is a loss, and sales above the break-even point is a profit. There are 3 ways to calculate: the income statement approach, the shortcut approach using unit contribution margin, and the shortcut approach using the contribution margin ratio. All right, so three ways. You got the income statement approach, the unit contribution margin, and the contribution margin ratio. So the break-even point using the income statement approach is that you're going to get the sales revenue minus the variable expenses minus the fixed expenses, and you're going to get operating income. Okay, and when you look at the sales revenue, you're looking at the sales price per unit times the units sold. That's going to give you the sales revenue. When you look at the variable expenses, the variable cost per unit times the units sold. Fixed expenses is the fixed amount of expenses, and then your operating income. So in your sales revenue, you know that $35 per unit times the units sold, $21 were the variable cost per units times the units sold, minus the fixed expenses. You know, your operating income is 0. And then if you look at the 35 minus the 21 minus the 7,000 and so forth, and then you also look at the variable cost per unit. Remember that 35 minus 21 was 14 units times the units sold, it gives you 7,000. Now, using the contribution margin approach, what you do is you have a formula, and that's going to be that the sales in units are the fixed expenses plus the operating income divided by the contribution margin per unit. So you know that the contribution margin per unit is going to be the denominator. That's going to be the $14. Fixed expenses were 7,000, and we have 0 of operating income. So 7,000 plus 0 divided by 14 gives you 500 posters. That's the break-even point. That's how many posters you need to produce. And the break-even point using the contribution margin ratio, again, the contribution margin ratio, remember that we got 40%, so that's going to be the denominator, 40%. So we look at the sales in dollars is going to be equal to the fixed expenses plus the operating income divided by the contribution margin ratio. So the sales in dollars is the 7,000 plus the 0 operating income divided by the 40%, you get 17,500. So how many posters does Kay need to sell to earn a $4,900 profit? So she's going to get the fixed expenses, 7,000, plus the 4,900, which is going to be the operating income. And then she's going to divide by 14, which is the unit. And then that's going to give you 7,000 plus 4,900. It gives you 11,900. And then the 11,900, you divide it by the contribution margin per unit, which is the $14. And that is, she needs to produce 850 posters in order to get that amount of profit. So again, remember that for the unit contribution margin, if Kay needs to, what does Kay need to sell to earn $4,900 in profit? Well, you get her fixed expenses, which we know were 7,000, plus the operating income that we know it's 4,900 divided by 14. So we work the numerator first, 7,000 plus 4,900. That's the new numerator is 11,900 divided by the 14 per unit. She needs 850 posters. Now the target profit, which is the unit contribution margin ratio, remember that was 40%. How much sales revenue does Kay need to generate to earn that $4,900 profit? Well, the sales in dollars, she's got the fixed expenses plus the operating income. So similar to the example that I previously showed you, 7,000 plus 4,900 in the numerator gives us 11,900. Now we divide by the 40%. Instead of the $14 per unit and dividing by 40%, we get 29,750. So that's 29,750 once you divide 11,900 by the 40%. And then, of course, you can also graph cost volume profit relationships, and also recall that you can use the income statement approach also, again, by working with the units sold, $35 of units sold, variable expenses of 21 and fixed expenses of 7,000. It gives you the 4,900 of operating income. So you can also use the income statement approach for that. Now, graphing cost volume profit relationships, if we look at 5 steps, in step 1, you're going to choose a sales volume, and then you're going to plot the point for total sales revenue at that volume. Excuse me. Then you're going to draw the sales revenue line from the origin through the point. In step 2, you're going to draw the fixed expense line, which is going to be a horizontal line that intersects the y-axis. In step 3, you're going to draw the total expense line, and you're going to sum, you're going to add variable plus fixed expenses. So draw the total expense line and add the variable plus the fixed expenses. In step 4, you're going to identify the break-even point where sales revenue intersects the total expenses. So basically in the graph, they're going to be intersecting like this, and that's where you're going to identify the break-even point where sales revenue intersects total expense. And step 5 is to mark the operating income and operating loss areas. Okay, and then using cost volume profit analysis to measure the impact of changing business conditions. So there's an analysis called sensitivity analysis, and you prepare for increasing costs, pricing pressures, and other changing business conditions. It's called the what if technique. What if sales price changes? What if costs change? What is the sales mix changes? And then you would use cost volume profit to conduct sensitivity analysis. And again, this is a crucial component of a lot of the meetings that you're going to be in. What do we have to do to generate more revenue? What do we have to do to optimize operations? What do we have to do to, decrease expenses? And then there's going to be what if. What if sales price changes? What if costs changes? What if the sales mix changes? So remember that changing the sales price and changing the volume, break-even point can change, unit contribution margin can change, and sales prices can drop, sales prices can go up. If a sales price drops, then the unit contribution margin drops. And then the volume needed to break even or to achieve target profits is going to be a higher volume needed to break even or achieve the target profits. If the sales price increases, so if the sales price goes up, the unit contribution margin goes up, and the volume needed to break even or to achieve target profits is lower. You need a lower volume to break even or achieve target profits. So this is very important, especially for your assignment, that remember that if the sales price drops, then the unit contribution margin drops. You need more volume to achieve the break even. If the sales price increases, the unit contribution margin increases, the volume needed for you to break even or achieve your profits is going to be lower. Higher variable costs sometimes have the same effect as lower selling prices, reducing the unit contribution margin. And then when you look at sustainability and the cost volume profit analysis, reducing costs and helping the environment, decreasing use of plastic reduces variable costs. Decreasing variable costs makes it easier to reach a target profit. If your costs are definitely lower, that's definitely a way for it to happen. You just have to consider other options. Are you sacrificing the quality for a more economical raw material or whatever item it is that you're trying to save money on to purchase? So these are decisions that you have to make. So I appreciate all of your attention during the video lecture. So now I'm going to make sure that we go over the assignment and that you have a good direction to successfully complete the assignment. So we fulfilled the week 4 objectives, which was the calculating the unit contribution margin and the contribution margin ratio, using cost volume profit analysis to find break-even points and target profit volumes, and also measuring the impact of changing business conditions. So we know what happens when the price goes up, when the price goes down, whether you need more volume, whether you need less volume, depending on that. So your first discussion question, explain the usefulness of the contribution margin ratio. Excellent. You've got that. Elaborate and give examples on why managers make pricing and special order decisions. There you got to apply your critical thinking. We covered the material, but here you got to elaborate and think outside the box and think beyond the box. And your third discussion question is on elaborate on how one decides to sell a product as is or process it further. So again, here you got to use critical thinking and think beyond the box. And then your final assignment for week 4 is the essay assignment. So So you're gonna read and analyze the steps for creating a cost volume profit graph. They're simple to create with Microsoft Excel. As an example, you can use Microsoft Excel 2016 using the following simple steps. So in row 1 of a new Excel worksheet, set up column headings for volume, revenue, and expenses. In row 2, enter a volume of 0 and then calculate the corresponding revenues and expenses at that volume. In row 3, enter a higher volume, such as the volume at the high end of the company's relevant range. Calculate corresponding revenues and expenses at that volume. Then what you want to do is you want to highlight the data with your mouse. Then click on the Insert tab on the menu bar and choose Scatter with a line as the chart type. So the chart type is going to be Scatter with a line. And then you're going to move the chart location from the menu bar and select New Sheet and OK. And then you're going to click on the Insert text box to add labels for the break-even point, the revenue line, the expense line, and so forth. And then you may have to play around a little bit with the formatting. And then after reading and analyzing these steps, read the following scenario. And you're going to have the scenario for Ready Hikers Incorporated. They're going to buy hiking socks for $6 a pair, and they're going to sell them for $8. Management budgets monthly fixed expenses of $12,000 for sales volumes between 0 and $12,000 and 12,000 pairs. Okay, so the hikers company is going to buy hiking socks for $6 a pair, sell them for $8. Management budgets monthly fixed expenses of $12,000 for sales volumes between 0 and 12,000 pairs. This is very similar to the poster example. Case posters, very similar to the oil change example. Okay, so they're going to ask you, you're going to be referring back to your textbook, and you're going to use the income statement approach and the shortcut unit contribution margin approach to compute monthly break-even sales in units. You're also going to use the shortcut contribution margin ratio approach to compute the break-even point in sales revenue. And in sales dollars, you're going to compute the monthly sales levels in units required to earn a target operating income of 16,000, very similar to the both examples that we saw. And then you're going to prepare a graph of Ready Hiking Inc. using a cost volume profit relationship, similar to the one on Exhibit 7-8 on page 391. And then you're going to, in 1,200 words, you're going to synthesize the concept from this week's readings as you respond to the following. Explain how managers use a cost volume profit analysis to make decisions when business conditions change. And responses must be substantive and contain research, analytical thinking, and critical thinking skills. So remember, do not copy and paste your responses from the textbook. I think you're going to do well on the week 4 assignments. I wish you luck, and I will remain available in the online classroom throughout the week, and you can ask me any other questions that you may have regarding the week 4 or anything related to the overall objectives that need to be fulfilled. Thank you and good luck.